All right, folks, some really major changes coming for the dependent care tax credit 2021. And I'm going to quickly dive into the changes and the planning opportunities for 2021. I will discuss the differences between 2020 tax law and 2021 tax law changes. Just keep in mind that these changes only apply to 2021 unless Congress decides to make it permanent. We think it might happen, but we're not certain. So for now, these changes apply only to 2021. This credit deals with the dependent care. So in other words, if you're spending on your child for daycare, that's your common example. This credit is meant for parents that are working. If you have one spouse that is not working, you would not be eligible for this credit under the old law, and I'm assuming under the new law. If one parent is working, one is a full-time student, and is or looking for work, then that would definitely still qualify. So don't neglect that item. All right, let's dive in. So for 2020, this tax credit really hasn't changed at all for quite some time. And it was a non-refundable tax credit, and basically everybody was eligible for it. It didn't matter how much your income was. Now, it was a $3,000 worth of qualified care expenses for one child and $6,000 of qualified care expenses for two children. This was a very low amount. Most people pay way above that for their dependents, for the child care. And, you know, if you've ever had a kid in the daycare, you know that the costs are you know, well in the 15 to 20,000, depending on your geographical location. So you could have easily topped that. And so these credits were nice, but they weren't exactly very generous, to say the least. So the way they used to work is you would basically have a tax credit. Now, just quickly to recap, you know, tax credits are dollar for dollar tax liability savings. So if you have a $3,000 tax credit, you're actually going to save in taxes $3,000. That's not the same as deductions. Deductions, if you have a $3,000 deduction and you're in the 20% tax bracket, you're going to save $600. That's basically how deductions vary from credits. And again, credits come in two different flavors. You have refundable tax credits, and then you have non-refundable tax credit. So the old tax credit for dependent care was non-refundable. In other words, it would reduce your tax liability to zero, but if you had more credits than you had tax liability, it would not refund you the difference. Now, a refundable tax credit would. That's the whole key. And so let's look at the old law. So we had, you know, if your AGI was up to $15,000, again, AGI is adjusted gross income, which you can think of it as income for most people, your gross income from all sources. So you would get a child tax credit of 35, non-refundable credit of 35% for each $3,000 for each child. So if you spent, for example, you know, $3,000 for child one, and your AGI was up to $15,000, your credit would be $1,050. Now, once your AGI would increase above that $15,000 mark, you would have a reduction of 1% for every $2,000 of increase in AGI. And once you would reach $43,000, your AGI was 20%, going anywhere above that $43,000 AGI mark. So most people would be basically receiving $600 per child if they had $3,000 and above in qualified care expenses for each child, no more than two children. So if you had three kids in daycare, too bad, so sad, you're out of luck. It's only two children at $3,000 each. All right, so that's how it used to work, and most people would receive that $600 tax credit per child, and it was always $1,200. Now, the huge difference, again, I mentioned that it's refundable in 2021, yes, but they also threw in this same abode, you know, requirement for half of the year in the U.S. or partial refund if above, if the abode test is not met. So that's basically something new that they brought into 2021. And but the key thing here is that the rules still stay the same as far as the parents having to have to be basically working. Okay, but now the qualified care expenses have increased dramatically. It's $8,000 per child. Again, no more than 2 children, and you're looking at $16,000 for 2 children, which is really more around the area of what people typically spend for daycare. Now, they did do away with the system over here for 2020, and they introduced a whopping 50% refundable tax credit if your AGI is up to 125,000. This is huge, folks. This is tremendous. I wish when my kids were young and in daycare that they had these credits, honestly, because like I said, what they did was a small credit, but this is big, right? So 8,000 at a 50% rate is $4,000 in tax credit. Wow. Now we're going to go into that a little bit and compare some other items that should really perk your ears up so you can plan. Now there is a reduction. It works the same way for 2021 as it did in 2020. So once your AGI is 125 or above, you're actually starting to phase out, and it's a 1% reduction for every $2,000 in increase of AGI, up to $185,000 of AGI. Once you reach that 185 and you're between 185 and $400,000 of AGI, that tax credit is at a flat 20%. Once you're breaking the $400,000 AGI mark, you're now going to have that same reduction of 1% for $2,000 of additional AGI going over that 400. And once, this is the key difference from 2020, once you're at 440 and above, your tax credit is 0. Back in 2020, it wouldn't matter how high your AGI was. That was one credit you can count on. But that's gone now. So once you reach 440, so sad, too bad, it's 0. All right, basically that's the major components. Let's take a look at the graph. The graph is pretty self-explanatory. It gives you an example of one child at $8,000 worth of expenses, and this axis here represents the actual credit. So at amounts of up to 125, we said you'd have a $4,000 tax credit. And once you start going, because it's 50%, right? Once you start increasing, you have that first drop, that first reduction of 2,000 for every 1% for every 2,000 increase in AGI of up to 185. And once you pass 185, you're going up to 400. That stays steady at that 20%. Once you reach that $400,000 mark, it'll start to decrease until it reaches 0 at 440. So that's basically the graphical explanation of what's happening. FSA. The FSA was always, if you haven't heard of the FSA, some people haven't, it's a flexible spending account. So the flexible spending account is basically typically done through work. And if your work offered an FSA, a flexible spending account, you can choose to utilize that amount out of your pay to go towards these dependent care expenses. And what it used to be is you would set aside from your pay, tax-free, of up to $5,000. It would be reported on your W-2 in box 10, and you would plop that in, and then you would lose your dependent care credit of up to $6,000. You would only be able to use the dependent care credit of the difference of $1,000. So that was a pretty interesting planning opportunity for many people, because what people ended up doing was they, for higher income earners, it was worth it for them to do a mix, to do an FSA and do a dependent care credit combination, because then they would actually optimize their tax picture, and instead of just taking the credit. So let's take a look at that example so you can see what that looked like. So typically, if we were looking at, let's say for 2020, working individual that had their job offer an FSA, and the FSA would say, okay, well, you can put away $5,000 through us, and you will shelter some tax, right? So this first example here compares taking the FSA plus the dependent care combination, and it clearly illustrates how somebody can save money by combining an FSA with a child tax credit. Now remember, it's $3,000 per child, so you had to have, the right set of circumstances, 2 kids. This is assuming you have two children. All right, so you would basically shelter $5,000 through your work at a rate of 32%. This is assuming an AGI of 375. Remember, I said this is for higher earning taxpayers. This strategy would work really well. So what they would do is they would, at a 32% rate, they would save $1,600 worth of taxes, and then they would claim that additional $1,000 as a child tax, as a dependent care credit on their Form 2441. And that would produce, because they were above that $40-something thousand AGI, obviously they would get a 20% tax credit. Here you go, it's $200 tax credit. So their total savings will be $1,800. Now, if you compare that to only taking the dependent care credit for 2 children, it would be $3,600 and $600 per child. So all you would have was $1,200. So you were obviously better off by doing this combination here if you had 2 kids and this was your scenario, which was, basically many people had that situation happening. So it was a great way to fly. Now, what's going on with 2021? This is key. All right. So if you're at AGI under 125, it's a planning opportunity. You wanna definitely take the dependent care tax credit only. Why? Well, simply because it's a 50% refundable tax credit for each child at $8,000. That's an $8,000 tax credit. I don't need to say anything else. All right. So you're looking at $8,000 in tax credits. Here's the big change for 2021. Now, if you're married jointly, $10,500 is the new FSA shelter. So you can put away a contribution of $10,500 or $5,250 if you're married filing separately. That's a big distinction from the prior year. Again, you're putting away more, you're saving more. And again, if we're assuming an AGI of 125, you're in the 24% bracket most likely. So your tax savings would be $2,520 for that component, and for the difference, you would claim a credit of 50% of the remainder, or $5,500. So you would receive a dependent care credit of $2,750 for total savings of $5,270. That's nothing compared to the child tax credit of $8,000, of dependent care credit of $8,000. That's the huge difference here. So if your AGI is below 125, you don't want to make any kind of combination. That might have been applicable to a prior year, but it definitely would not be applicable to 2021. Now, the second example looks at a high income taxpayer, and that's where you're actually still wanting to follow along the same type of strategy as you did in 2020. Yes, you still want to do the FSA, take full advantage of it, and utilize the tax credit for the difference. You'll come out winning because you will have saved $4,460 in taxes as compared to taking 20% of $8,000 and saving only $3,200. So that's it, folks. That's pretty much my quick presentation on the changes that are coming for 2021 dependent care tax credit. Thank you and have a great day. Remember, Freeman CPA, where your success is our success all day, every day.